In the news today, you're constantly hearing about interest rates and inflation. Inflation is up exponentially year over year, and most of my clients are asking, why is it up, or what is inflation? Inflation is simply the cost of goods and services increasing from where they were before. Normal inflation is actually good for the economy. If you think about it, inflation is driven by supply and demand. And the Federal Reserve is targeting about a 2% inflationary rate, which means that the supply chain can just keep up with the demand for that product. Hyperinflation, or very high inflation, can be a lag on the economy, and it's something that we need to pay attention to. Ultimately, with hyperinflation, let's just use 10% as an example. If inflation is up by 10%, that means you're able to purchase 10% less with the same amount of money as you were a year prior, right? Think about that. The economy is driven by consumer spending, and if you're able to buy less product, that starts to put a damper on future growth. Two key factors are being driven by this. You think about the pandemic and what we faced over the last 18 months. We have put a lot of stimulus and money into the economy and into consumers' hands, whether that be forbearance on mortgages, forbearance on student loans, a moratorium on evictions, stimulus checks that were sent out to individuals, and then the child tax credit of $300 per child per month to certain families. Families received extra money, and a lot of people spent it, which drove up demand and desire to buy product. At the same time, we've had the largest clog in supply chain in the history of the United States with the pandemic. We can't even get the product off of the ships fast enough to distribute it to satisfy the demand to buy the product right now. So anytime you have a high desire to spend and a low inventory, the remaining product has to go up in cost, right? So when we look at that, we know inflation is bad when it's in that hyperinflation mode. The way that the Federal Reserve has to offset inflation is by increasing interest rates. So you hear that and you say, why does increasing interest rates have an impact on inflation? And that's a great question. So let's break it down a few different ways, right? When we look at interest rates going up, put yourself in the average American shoes, right? You may have student loans, $10,000 of credit card debt, looking to purchase a home, looking to purchase a car. If interest rates are higher, meaning that you're paying more to creditors, paying more to financial institutions, paying more to banks, you have less cash flow to buy other products. So what happens is your demand or desire to buy those products comes down, and it allows the inventory to start catching back up, right? Which ultimately, if you have an oversupply of inventory, that inflation or product cost can come down. That's a normal economy, okay? The issue is right now is not normal. We're in the midst of a pandemic, and what we have to pay attention to is just because interest rates are going up in the short term, it will not solve the logistical issues due to COVID of bringing the inventory here faster. So we do anticipate interest rates going up in the short term, right? And it could be 3 rate increases, it could be 5 rate increases, etc. But we are still anticipating inflation to remain fairly high over the foreseeable future until we can get the inventory back in line due to COVID. So ultimately, if you have any questions, please feel free to click the link below and reach out to us and schedule an appointment. We can go more into detail about how certain investments help hedge against inflation versus ultimately just riding the market and hoping that it performs.